Imagine waking up one morning and realizing that the house you've owned for years is suddenly costing you thousands more. Not because you changed anything, but because the rules did. That's exactly what's happening right now with the new property tax law. Most people won't notice it until the bill arrives, and by then it's too late to react smartly. This isn't just about numbers. It's about how quietly policy can reshape your financial future without asking for your permission. Here's the uncomfortable truth. Property tax isn't just a static obligation. It evolves. Governments adjust it, redefine it, and sometimes redesign entire systems around it. And when that happens, those who don't understand the shift end up paying more, while those who do reposition themselves. The difference between the two: awareness. Right now, a new wave of property tax regulations is rolling out, and it's not just targeting luxury homeowners or big investors. It's broader, deeper, and more systemic than that. If you own property, plan to buy one, or even rent long-term, this affects you directly. And yet, very few people are actually paying attention. So in the next few minutes, we're going to break this down in the simplest way possible. No jargon, no confusion. Just clarity, because once you understand what's changing, you'll never look at property ownership the same way again. Welcome to the channel where we simplify complex financial systems into something you can actually use. Today's topic is one of those silent shifts that doesn't feel urgent until it hits your wallet. The new property tax law is not just an update. It's a structural adjustment that can change how wealth is stored and transferred through real estate. If you've ever thought of property as a safe investment, you're not wrong. But what most people overlook is that property is one of the most regulated assets in the world. And whenever governments need to adjust revenue streams, property tax becomes one of their most powerful tools. The problem is not the tax itself. The problem is how it's calculated when it's reassessed and what factors suddenly start to matter more than before. These changes often come quietly, buried in legal language, making them easy to ignore but expensive to misunderstand. That's why today, we're not just explaining the law, we're translating it into real-life impact. What it means for your cash flow, your investment strategy, and your long-term financial planning. To understand the new property tax law, we first need to understand why it exists. Governments rely heavily on property taxes because they are predictable and stable. Unlike income taxes, property doesn't move. It can't be hidden easily. It's visible, measurable, and consistent. But over time, property values change, sometimes dramatically. In many regions, property prices have surged, creating a mismatch between outdated tax assessments and current market values. This gap is what governments are now trying to correct. The new law often introduces more frequent reassessments, updated valuation methods, or revised tax rates. On paper, it sounds fair, align tax with actual property value. But in reality, this can create sudden financial pressure for property owners who were not prepared. And here's where it gets interesting. These changes don't impact everyone equally. Some areas will see minimal adjustments, while others may experience significant increases. Understanding where you stand in that spectrum is critical. The biggest problem with the new property tax law is not that it exists. It's that most people don't understand how it works. They assume their tax will increase slightly, gradually, predictably. But that assumption can be dangerously wrong. In some cases, reassessments can jump dramatically, especially in rapidly developing areas. A property that was undervalued for years may suddenly be reclassified at a much higher market rate. That means your tax bill doesn't just rise, it spikes. Another issue is the hidden complexity. New formulas, zoning considerations, infrastructure developments, and even environmental factors can now influence your property's assessed value. It's no longer just about location, it's about future potential, and perhaps the most frustrating part. Many property owners only realize these changes after receiving their tax notice. By then, options are limited and reactions become emotional rather than strategic. So what exactly is changing at its core? The new property tax law focuses on recalibrating property values to reflect current market conditions more accurately. This often involves updated assessment cycles, meaning your property could be reassessed more frequently than before. Additionally, some systems are shifting toward dynamic valuation models. These models use real-time data such as recent sales, neighborhood trends, and economic indicators to determine property value. It's more precise, but also more volatile. Tax rates themselves may also be adjusted. In some cases, governments lower the rate but increase the base value, resulting in a similar or even higher total tax burden. It's a subtle shift that can easily go unnoticed if you're only looking at percentages. Finally, exemptions and deductions may change. Certain benefits for homeowners, retirees, or specific property types could be reduced, expanded, or restructured. This is where many people either save money or lose it unnecessarily. Here's what most people don't realize. Property tax is not just a cost, it's a signal. It reflects how governments view your property's role in the broader economic system. When taxes rise, it often means your area is becoming more valuable. But that also means something else. Your cost of holding that asset is increasing. And if your income or rental yield doesn't keep up, your investment becomes less efficient over time. This is where many investors get caught off guard. Another overlooked insight is timing. Property tax changes often lag behind market trends. By the time taxes increase, the real opportunity may have already passed. Those who act early before the adjustment are usually in a stronger position. In other words, the smartest investors don't just react to tax changes. They anticipate them. They study patterns, understand policy direction, and position themselves accordingly. This is the moment where your mindset needs to shift. Stop seeing property tax as an unavoidable burden. Start seeing it as a variable you can plan around. Because here's the reality. Two people can own similar properties in similar locations and pay very different amounts in tax. The difference comes down to knowledge, timing, and strategy. Say you understand how assessments work, you can challenge them, optimize your property classification, or even choose locations with more favorable tax structures. Suddenly, you're not just paying tax, you're managing it. And that's the breakthrough. Control doesn't come from avoiding tax. It comes from understanding it better than most people do. First, review your property assessment regularly. Don't assume it's correct. Errors happen more often than you think, and correcting them can save you significant money over time. Second, stay informed about local policy changes. Tax laws are not static. Being early in understanding new regulations gives you a strategic advantage. Third, consider consulting professionals, tax advisors, or property experts, especially if you own multiple properties. The cost of advice is often much lower than the cost of ignorance. Finally, align your property strategy with tax realities. Whether it's renting, holding, or selling, your decision should factor in not just market value, but tax efficiency as well. The new property tax law is not something to fear, but it is something to respect. It has the power to quietly reshape your financial landscape if you ignore it. The goal here is simple: stay informed, stay proactive, and stay strategic. Because in finance, the biggest losses rarely come from what we know, but from what we overlook. This video is for educational purposes only and should not be considered financial or legal advice. Always consult a qualified professional before making major financial decisions. If you found this helpful and want more content like this simple, clear, and practical, make sure to subscribe. And if you have questions or thoughts, drop them in the comments. Let's learn together.